Every time I'm talking about taxes, I always play that scene from Seinfeld,
Oh, no.
where Kramer, he's talking about how companies, they could just write it off. And Jerry goes, "You don't even know what a write off is." Hey, I'm Josh. This is the In Your Corner podcast from CBS News Philadelphia. It is tax time once again. Cue the grumbles here. And whether you are someone who maybe likes to get yours filed and out of the way, or you are among nearly 1 in 4 Americans who put it off for as long as you possibly can, there are a lot of changes you need to know about this season. From deductions that could keep more money in your pocket to credits that could give you a bigger refund. Certified financial planner and founder of Forge Wealth Management, Melbourne, Regina McCann Hess, is here to help us walk through all of this.
All this fun
Oh,
stuff.
so fun. But no, we appreciate that you're here because there's a lot of different things here, and you don't want to leave any money on the table or mess up and have the IRS come and knocking on your door, right? So look, at this point, if not already, you're getting your W-2s and other tax forms in the mail, or they're coming to your email inbox. IRS officially started accepting returns a few weeks ago. So just how behind am I if I have not started on any of this yet?
I think you're about average.
Okay.
It's okay. You have time.
All right.
But your accountant will not like you if you give it to them on the 10th or 12th of
Yeah,
April.
we advise not to do that.
do not.
All right. So as I'm starting to get all my forms and everything, where do I begin? What do you advise people to do?
I think you need a checklist just to keep yourself organized. And if you work with an accountant, they usually give you a tax organizer. It could actually be as big as a binder. You never know.
Oh,
but
geez.
it's a really good checklist. But if you don't have an accountant, if you're able to do your taxes on your own, then you can create your own checklist. I mean, basically, just like, what do I usually get in the mail or email every year around this time? The 1099s, like you said, the W-2s, anything work related, anything. If I have business accounts or investment accounts or bank accounts, did I get interest? Okay, I should get a tax form from them. If I took money out of a retirement account, I should get a tax form for that. Regardless of what the tax form is called, know where you took money out of, know where you're earning interest and dividends and things like that. If you've earned money or took money out of an account that year, bought, sold anything, you should probably expect a tax form.
High yield savings accounts, all of those things. Yeah.
Yeah.
And they do they kind of come all fast and at once. So yeah, making sure that you've got a list of exactly what you've got and what you're missing, because sometimes you might need to contact the IRS, right, if you haven't gotten certain forms, or the specific institution.
Yeah, the specific institution. Now, the forms regarding the retirement accounts usually come out first. They're really easy because it's, easy. Here's what you took out.
Yeah.
Here's what you owe. Banks are usually pretty quick. The investment accounts, your brokerage accounts and whatnot, they're the ones that trail sometimes into March, because for them to give you that tax form, they need to get the information from XYZ mutual fund company who's giving those dividends. They have to wait for the reports from them to be able to create their own tax form for you. So there's a delay there.
So even if you want to be proactive, in some cases you have an excuse.
Yes, you can get everything else
Yeah,
ready though.
yes.
And those forms do start coming out in February. We have them coming out in waves. So we've had a couple waves already, but we also know that we have a wave or two in the first week of March. So those clients are usually grumbling a little bit more, and I completely understand why they grumble.
All right, so just keep that in the back of your mind
Yeah.
if you're maybe still waiting on a few. Okay, so you've got all the all the documents you need. You got your checklist. What are some other things to consider as you're going to file? I'm thinking maybe life changes or something that happened in that tax year.
Yeah, anytime there's been a birth, a death, a divorce, things like that, you want to be cognizant of. If you were divorced halfway through the year, you are now filing a separate tax return. If, however, you became a widow or a widower in 2025, regardless of when during that year your spouse died, you can still file married filing jointly for that tax year. And that saves a little bit because, obviously your life is in transition. There's a lot going on, especially emotionally. For you to get that one extra year of joint tax return does help.
And when you were here last time on the podcast, we were talking about finances and divorce. There's also the sort of, you can be in an interesting window where as long as you were still married up until the end of the
Yeah.
tax year, right? Even if you're divorced now,
Yeah.
you would still file
Married
Married.
filing jointly. Now, obviously, you both have to agree to it, but there's a lot of reasons why you would want to still file married filing jointly, because if you file separate, the IRS does not like that, and they cut you a lot. Like, you lose a lot of deductions and things like that, so you're going to pay a much higher tax bill.
You just have to come to a mutual understanding.
Mutual understanding ahead of time, and maybe in writing. Like, if there's a tax refund, how is that going to be split? If we owe tax, how is that going to be split? Like, what percentage does each spouse pay? That should be agreed upon before you file that tax return.
So we've been talking about this now since last summer with the passing of the big spending bill. There are a lot of changes to deductions and different credits that will be impacting a lot of taxpayers this year, potentially meaning a bigger return for you at the end of the day. Can we go through some of those now?
Yeah, absolutely.
So I think one of the big ones that people are very excited about, there's the no tax on tips.
Yes.
Right?
Yes. Tips, it's up to $25,000. That's huge.
Yeah, and then so you're deducting whatever that amount is it's got to be qualifying, reportable tips, right?
Yeah.
And it's only, there's qualified occupations, right? I think the language was like customarily workers who would get tips.
Yeah, like the people working in restaurants, not the person working at, I don't know, the convenience store
Sure.
and is now asking for tips.
Yes, exactly. Yeah, so there's a good caveat there
Yes.
to try to, minimize any sort of abuse of that. Overtime, that's another big one too, right? It's up to, a certain amount, specifically, I think, on the time and a half portion
Yes.
of your overtime. And that's taking your tax liability from your overall income, right?
Yeah, and it's really going to help families in the United States. They're working overtimes, to help their company, but also to help their family. And if some of that is, excluded from taxing, that's great for the families.
And these all have phase outs. What does that mean?
So if you make too much money, you lose the deductions. So there are charts on the Beautiful Bill Act that tell you, yes, this looks great, and you can have it. And then you see the fine print. Always look for the fine print, because the fine print says, well, you have to make under this amount. And if it goes beyond that amount, it's phased out. And then after a certain amount of money that earned income, you totally lose it.
So it's kind of like a scale. There's not a one like you get it or you don't, but depending on as your income increases, you would get less.
Yeah,
less
at least that's the way I read it.
Yeah.
I saw that after a certain point there was a phase out, and then there was a drop off.
There is. Yeah, I want to say the range is like 150-ish to 250 or something like that.
Yeah.
What are some other big changes that you're hearing questions from your clients?
Well, one of my favorite things is the deduction for seniors over 65.
Yes.
And I am loving that, because that is helping so many seniors in America. So if you're a single senior over 65, you get a $6,000 additional deduction. That's in addition to your standard deduction. And then if you're married, you both get that $6,000. So that's $12,000. Yeah,
That's huge.
It's a lot of money, right? Plus the standard deduction, which is a great amount of money. So that's able to really drop people's earned income down quite a bit.
Yeah,
That's my favorite thing.
Yeah, knocking down a huge tax liability
Yes.
there. There's also there's an interesting one. There's a car loan interest deduction.
Yeah, I got really excited about that, Josh, because I was looking for a car, and
Yeah.
I'm like, oh, I get to exclude up to $10,000 of the interest. I'm like, game on, I'm buying my car. And then I read the fine print,
Yeah.
and I made too much money for it.
Okay, so there is an income
don't
phase
get
out.
it.
Okay,
Yeah, but
all
it
right.
was part of my reasoning for finally buying a new car.
Get out.
It was.
Did
Well,
you?
my car
did you,
was almost 10 years old, so
Did you still get the new car?
I darn right did.
All right, so you still get the new car smell. That's
still
something, right? Yeah.
But I don't get to deduct the interest.
But yeah, to your point, you deduct up to 10 grand in interest on the loan for a new car, and I think there's also the caveat: it's got to be final assembly of the car,
In America.
right? Which is hard too, because so many cars are made with parts and things from all over the world now.
Yeah, but you can find, oh, believe me, I had my short list. You can figure out which cars, and even though they have a foreign emblem on them,
Yes.
a lot of them are made here or assembled here. So I'm sure there's some kind of a list that you can make up for yourself.
Yeah, it's not as black and white anymore in terms of figuring out what's an
No.
American-made car
No,
anymore.
no,
Yeah.
but also within each car brand, not every single
That's
car is
right.
manufactured here,
That's very true.
right? So you do have to be careful of
Yeah,
that.
you get a Ford that's made in China or
Yeah.
Mexico or something. Yeah.
Right.
Hmm.
Now, the other thing is, and that's a good point, American made cars are sometimes made somewhere else
Yeah.
and brought in. The other thing is, some of these, like I believe the car interest and the senior deduction, they're not permanent. Like the senior deduction ends in 2028 unless Congress is kind enough to extend it. And I believe the car interest may also be a short-term thing.
Hmm. Which was the case too. A lot of these some of these were extending,
Yeah.
right? Ones that were in the last spending bill. So that's always a good point as well. And then a lot of people were very excited about the increase on state and local tax deduction caps. Huge increase from like 10,000, I think, to 40,000 if you're
It's
a single filer.
yeah, it's great.
And those will have annual adjustments too.
I
think,
believe
right?
so.
A 1%
Yeah,
annual.
they did do that overall in some of the tax type bills in the Big Beautiful Bill Act. They added inflation kickers because some of these numbers haven't changed in years to decades. So they're finally adding inflation kickers to some of them.
And important too to kind of differentiate a deduction versus a credit, because even like the car loan one, initially I was thinking, oh, it's a credit. It's not like the EV credit,
Oh yeah, no,
right?
it's
So
different.
what's the difference?
That's a tough one. I think I will defer to the accountant for that one because I might screw it up.
Well, goes to okay, so I don't feel so bad not knowing it then either.
I think I know, but I don't
Yeah.
want to like tell your listeners bad info.
On the topic of credits, there's also I think a larger child tax credit as well that parents can claim too. That
Oh, yeah.
increased, and those changes it'll now increase annually based on inflation, which is good. So that's a big one for
Right.
parents.
And for parents also, 529 plans, you used to only be able to use $10,000 for K through 12 tuition. You can now, it's now up to $20,000 a year
Oh.
that you can pull out.
Oh, okay.
Yeah. Well, I mean, it's good and bad, right? Because you're saving that money for college,
Yeah, you don't
but
want to
then
be.
you're starting to take it out early. So it's like, are you going to have enough left for college? So there's a thing you have to think about there.
Can medical expenses be deducted?
Well, it's according to your adjusted gross income, I believe. There's a percentage. I'm not sure if it's 7.5 still.
Okay.
It's over that amount that would be able to be deducted. So you know, obviously you would have to be pretty ill or not have insurance. Well, it's pretty easy to spend a lot of money once you have a big illness
Yeah.
because we have great healthcare, but it's extremely expensive. Another place where I have seen that used is when retirees move into retirement communities that are phased, like it's independent to assisted
Okay.
to nursing home, but they have a caveat as part of that, as part of their entrance fee and their monthly fee, there's part of that is medical. So a lot of them, especially the first year moving in, because they have to put such a large down payment down and part of it's medical, that year usually a lot of people get to use it.
This is why we all need tax preparers.
Yes, I will not listen. I do not do my own taxes, and this is why. Like, I know enough to be dangerous and to educate, but I need my accountant
It just goes to show,
all
yeah,
day long.
everyone still needs a professional, right?
Yes.
Yeah. Okay, this question always comes up every year. How do you decide whether to go the standard deduction or to itemize?
So you can actually do like a little math worksheet, right? So the standard deduction it's right there on the paper. So you know, like 30 some thousand. I forget the exact amount, but it's around $30,000 for a married couple. And then you can just make a short checklist on, you know, a little loose leaf paper. Okay, if I have mortgage interest, which was also something that was brought back in the Big Beautiful Bill Act, my mortgage interest, this, that, and you make your list and see what it adds up to. 9 times out of 10, or maybe 8 times out of 10, the standard deduction is probably going to be more than your itemized. And that's only true after several years ago, the standard deduction was given a big lift. Prior to that, your itemized deductions, actually, you probably could deduct more. But now that that standard deduction is so high, most people are using that standard deduction.
Yeah, talking about all these credits and deductions and numbers. I mean, we have our own cheat sheet here that
Yes.
Regina uses because there's a lot.
There is. That's why I'm trying to avoid saying numbers because there's so many numbers swirling around in my head right now. I'm like, going to say the wrong thing.
What about looking at some ways to keep some more money in our pocket, lowering our tax liability, what are some other things that you would advise some clients that they could do maybe now that you could then set yourself up for success even next tax season?
Well, obviously, contributing to your retirement plans at work as much as you possibly can. Now, there's a little caveat to that because the part that's tax deductible is the traditional part. So you don't pay taxes now, you pay taxes later.
Right.
So that's where you can save taxes.
And then whereas the Roth, what's the difference there?
Yeah, the Roth, you pay the tax bill now, right? So you pay the tax bill now, the money goes into your Roth 401k, it grows just like the traditional. But when you take the money out in retirement, that money's tax-free. You never pay taxes on that money again. So you have to look at both and say, save tax money now versus tax money later. And a lot of times you do a little bit of both. You want to make your accountant happy and you want to make your pocket happy right now, but you also want to think of future you. Future you is going to love you for paying a tax bill today and then have tax-free money 20, 30 years from now. So there's the caveat. Accounting, we have to make our accountants happy. We have to make your future self happy. So a little bit of both.
All right.
So that's one thing. Also, IRAs, if you already have a 401k, a retirement plan through your work, your IRA contribution, you should still do it. It won't be a deductible contribution though, because you only get, if you are, when you have your W-2, it has a little check mark on there, right?
Yeah.
So if it has that check mark, it means that even if you didn't participate, you had the opportunity to participate in the retirement plan. So therefore, an IRA contribution won't be deductible. However, thinking in future you still want to do it. And again, if you make under a certain dollar amount, that's a no-brainer. If you can contribute to a Roth, you do, because you're not getting a tax break anyway. So that's one of the things. Obviously, contributions to nonprofits, things like that. Also, thinking about not to save taxes, but to make sure you don't get into a situation where you're going to have a big whopping bill if you don't want one. Looking at the tax withholding that they're doing on your paycheck and seeing, wow, does that match up with, what I really am? And if I'm getting a big bill that's due at this tax season, I might want to go back and adjust that up for my withholding.
That comes up every year too. Like, is it, because some people will argue the philosophy is you don't want to be getting a big refund. It's an interest-free loan you gave to the government, right? But then you run the risk of, if you're not withholding enough or too much, then you have a tax bill at the end. So it's like, how do you, I guess it's up to your personal preference.
It is a personal preference. Some people love getting that money back, and they actually need it that way because they don't trust themselves to save, and this is the way they get a little kerplunk of money and they use it for other things. Whereas other people, if they owe even $1, they're furious. They're like, oh, I had this down pat. So that's where you're really adjusting your numbers every year to be able to be in line with what your tax bill is going to be. Yeah. The other thing is, you're given a certain period of grace for how much you do owe after the fact. But if it's over a certain percentage or, outside of that window, you're also getting a kind of a penalty for owing too much tax. So you do have to be careful with that, and you have to play with the numbers ahead of time.
I guess what's better, a bigger check to you or a whopping bill that all of a sudden you've got to figure out how to pay, or you got to pay more on because it's too big.
Pay more. Yeah. And I really don't want to give the government an interest-free loan.
No,
I really don't. They get enough of my money.
But it is a hard numbers game when you're trying to determine the withholding and to find sort of that sweet spot. I've kind of been dealing with that for years because I was of the philosophy that you're right. I don't want a big refund. But then inevitably, I've had to pay something.
Yeah, and here's the thing. When you have a life transition, whether or not it's a marriage, a divorce, becoming a widow, even retiring and changing your income status, those next 1 to 3 years, you're going to need to have a little bit more hands-on on your withdrawal rate for your taxes. And it doesn't mean because you set it in January, that's what it stays at. You can go back and change it in June, July, whenever, and you're not going to have it exactly where you want it for 2 or 3 years because you have a lot of changes and you have to adjust with them.
Every time I'm talking about taxes, I always play that scene from Seinfeld.
Oh, no.
Where Kramer, he's talking about how companies, they could just write it off. And Jerry goes, you don't even know what a write-off is.
I'm surrounded by Seinfeld fans. We were in the airport the other day, and they were doing Seinfeld skits. I was like, oh, no.
It's always applicable. There's some life event that it's
You can
applicable
take
to.
a reservation. You just can't hold the reservation.
Thank you. Thank you. We could end there. No. Here, real quick, a lightning
Yes.
round. Best way to get my return the quickest.
Oh, electronic. Yeah, and actually, it's rare that you can actually do a paper file return anymore anyway. I was very resistant to this in the beginning because I like my paper, and now I've gotten over it because I have the PDF copy. But the paper, they don't really want the paper. Electronic is safest anyway. And I know also you'll want to get a 6-digit code from the IRS for filing.
Yes, I was going to ask you about that because this is a good way to protect yourself.
So what's happening is there's a lot of identity theft out there, and people will file a fake tax return in your name and get the refund sent to them, and you never know it
Until you go to file.
right
Yeah.
until you go to file and the IRS says you already filed your return, and then you're like, what? So that 6-digit PIN helps protect that from happening. Nothing is perfect, but it does help prevent some of that activity.
Yeah, I mean, you'd be surprised. It happens more than you might realize. I've had viewers reach out and
Oh, yeah.
they couldn't believe it
Yep.
because all it takes is just enough information about you. And God knows we've had so many data breaches and other things. I'm sure everything's ripe for the picking if they can
Yeah.
piece it together.
Oh, yeah.
Do you know, you have to get a new PIN each year?
You don't.
You don't.
I don't.
So it's like a
mean,
one and done. You get
yeah.
it. You don't have to think about it.
yeah. My PIN, when I get my tax organizer and then I sign electronically, it's there. I don't have to reapply for it every year.
One simple step that could make a
Yes.
world
Yes.
of a difference.
Yes.
And then finally, too, if I owe money, best way to get that payment to the IRS.
Okay, you can do the old-fashioned route of writing those things called checks. I don't know. Does you write?
I think I have some of those lying
I
around.
was
I
wondering,
don't.
do you have
know,
any?
yeah.
I still have checks, and I do still write some checks sometimes, but a lot of times people are now electronically paying their payments to the IRS, and that way there's no question as to whether or not it was paid and was it paid on time, because sometimes you'll have a payment, especially if you mail it, it gets lost. Or the IRS doesn't cash the check, and then guess what? You get a penalty because you didn't pay your tax. So the electronic payment is becoming more and more popular, but you have to be comfortable with the IRS having a direct link to your bank account.
Sure.
But guess what? They know how to do it.
And it is nice, too, because then the refund automatically
It does.
gets put into through an what is it?
ACH, yeah, it comes-
deposit.
And that part's okay.
Yeah, we like that. We like the
Oh,
getting the money
yes.
part.
Yes,
Yeah.
Santa came. Yes.
Regina McCann Hess, thank you so much for your help as always on this. Regina is the founder and a certified financial planner at Forge Wealth Management in Malvern, and we always enjoy you coming on and helping us through. It's a lot of numbers.
Yeah. But I'm thinking to myself, I'm like, wow, I was laughing a lot today. I don't know how.
Who
but
knew we could have fun with taxes?
I know.
I think we've accomplished something no one thought we could. So, Regina, thank you.
Thank you.